Hi folks, Joe McQuaid, Wealth Preservation Associates here, and I hope you're having a wonderful day. This week, we are continuing our series on life insurance. I hope you had a chance to see our earlier videos on the types of life insurance and the uses of life insurance. If you didn't have a chance, please visit our website at www.4wealthpreservation.com, and you can view those videos and numerous other videos on various insurance topics. In this video today, we are going to talk about life insurance and taxation. At the outset, we must provide this disclaimer. We at Wealth Preservation Associates are licensed insurance specialists, and we are not tax specialists. When looking for tax assistance, please talk to your local tax specialist or your CPA. What we can do is share with you some of the tax favored status that life insurance does have, and how that might be useful to an individual or family trying to plan for the future. Let's start with these three facts. A life insurance death benefit is distributed tax-free to a beneficiary. Life insurance cash values grow tax-deferred. And life insurance policy loans are not taxed unless a full surrender occurs. We're going to go into more detail on each of these areas to ensure everyone watching is aware how taxation works in each of these situations. Let's talk first about the beneficiary distribution. If there's a single wonderful attribute of life insurance, this is probably it. If you don't want to pay attention to all of the other wonderful things that life insurance can do, one thing that you should give full attention to is the fact that this death benefit, a death benefit for life insurance, will be distributed to your heirs, to your beneficiary, tax-free. This is the most beneficial element of life insurance. Almost all other wealth transfer assets will have some level of taxation applied. So for an example, if you have a $500,000 life insurance policy, you pass on, that distribution takes place to your heirs completely free of taxes. If that were an IRA, there's a good possibility that the taxation on an IRA of that size would be approximately 40%. So are you leaving $500,000 or $500,000 to your beneficiaries? Absolutely not. Even for a non-qualified type of investment, you're still looking at potentially significant taxation. On a life insurance policy, there is none. The single best element about having life insurance. Cash value. Growth in the cash value of permanent insurance is not taxable while accumulating. I do emphasize permanent because there is no cash value associated with term insurance. If you have a whole policy, a universal policy, universal index policy, variable policy, any of those is considered a type of permanent life insurance. And as a result, if you are funding it with enough premium, over time you'll begin to see cash accumulation, which is tax deferred. When you look at other forms of savings, growth is taxed as income annually. For instance, CDs or savings account. We're all familiar with that 1099 we get at the end of the year. And also, it bears mentioning at this point, that 1099 won't be for a large sum of money unless you have an immense amount of money in your CD or savings account, because today, April of 2016, we're still looking at sub 1% rates on savings and about 1% based upon how long you're willing to commit to the CD, maybe 1.75% on a CD. Also on a cash value, once you build cash value in your life insurance policy, and once you have surpassed the surrender period on your life insurance, the cash values with withdrawals can be taken out untaxed if the withdrawal does not exceed the premiums paid. Those are known as partial surrenders, and in our next chart we're going to talk about policy loans, but If you do take out your cash value, you can remove that cash value. It will not be taxed until you take out more cash than the number of premiums you paid. And folks will scratch their heads sometimes and say, well, how could you do that? You certainly can do that. If you hold a life insurance policy for a number of years, for a long enough time, you will in fact have more cash value in that policy than premiums that you paid into it. Policy loans. What is a policy loan? Policy loan is when you have built up the cash value, but rather than surrendering it, in other words, completely taking it out of the policy, you borrow the money from yourself. And as we all know, loans are not treated as income. You will pay interest, and it's paid back to the cash value account at established rates. Those loan rates usually, currently, are about 4 to 6%. Think about it if you were taking income or getting income, whether it be from an IRA or some other source. Those tax rates are anywhere from 15 to 35% and higher. So again, this is a very good decision when you're looking to get additional income at a low cost to yourself. There are some tax pitfalls to avoid. The first one, and the biggest one, is called a modified endowment contract. In the mid-1980s, the IRS was starting to realize that many wealthy individuals had found a loophole in the life insurance environment. And what they did is they started buying very, very large death benefit policies that allowed them to put immense amount of premium into that death benefit policy, thus creating a tax-deferred or a tax-free withdrawal capability on their life insurance policies. So the IRS in the mid-80s decided to no longer allow significant overfunding of life insurance with the sole purpose of creating large cash value accounts intended to avoid taxable proceeds. Well, if anything tells you that a life insurance policy is a good investment to defer or avoid taxes, this will tell you that, because the IRS decided they needed to step in and make it not a totally ridiculous tax avoidance type of legal vehicle, and they made it a little bit more practical as far as the amount that you can invest and the amount you can take out. Still, for middle-class America, this is a wonderful opportunity to be able to get tax-free dollars and take them out as you need them. Also, a thing to realize, this is an added benefit that now that Social Security is taxable at certain rates based upon how much you make, by taking your additional income via policy loans out of your life insurance policy, you avoid declaring that as income, and in turn will possibly avoid additional taxes on your Social Security. So there are a lot of good reasons to investigate this type of life insurance policy as a good part of your financial portfolio. Taxable withdrawals, partial or full surrenders of life insurance policy cash values that exceed the amount of premiums paid can cause a taxable event. So you do need to be careful. Again, it is important to consult with a tax specialist before deciding on how you want to take and how much you want to take out of a life insurance policy. But at the end of the day, it creates the opportunity to have a tax vehicle that you can avoid taxes with, either for the long term or as needs arise. What I would like to have you do is visit our website at www.4wealthpreservation.com or call us at 407-593-2243, and we'd be happy to talk to you about the different types of life insurance and how the life insurance might fit into your financial portfolio. Thanks so much for your time today. We do appreciate it, and we look forward to seeing you again when we produce the next video on some of the financial products, insurance products that we offer to you.